What is the true measure of success in the world of finance? Is it a single brilliant trade that makes a fortune overnight? Is it a spectacular year of triple-digit returns that captures the headlines? For a brief moment, perhaps. But the financial markets are a relentless and unforgiving arena. They are a graveyard of shooting stars, of geniuses who burned brightly for a moment before being extinguished by the next unforeseen crisis. The history of Wall Street teaches a humbling lesson. Short-term success is common, but long-term survival is the rarest of achievements. The true measure of mastery, therefore, is not brilliance, but longevity. It is the ability to not only generate wealth, but to preserve and compound it, year after year, decade after decade, through the inevitable and often brutal cycles of boom and bust. It is the ability to navigate the gauntlet of history, to withstand the crash that no one saw coming, to endure the grinding bear market that drains the soul, to resist the euphoric bubble that tempts even the most disciplined mind. There is perhaps no single figure in the history of investing who embodies this principle of longevity more completely than Philip Carret. His is not a name that is always shouted from the rooftops like the great speculators, but in the circles of the world's most serious investors, it is spoken with a unique and profound reverence. His career began in the aftermath of the First World War and did not end until the dawn of the Internet age. He was an active investor for over 70 years. He saw it all. He witnessed the dizzying euphoria of the Roaring Twenties and the abyssal despair of the Great Depression. He invested through World War II, the great post-war industrial boom, the stagflation of the 1970s, the nifty 50 bubble, and the shocking violent crash of 1987. Through it all, he did not just survive. He thrived, quietly and consistently compounding his and his clients' capital with a wisdom and a temperament that seemed almost immune to the madness of the crowd. Warren Buffett, a man not given to idle praise, called Philip Carret one of his heroes, a man from whom he had learned a great deal. Carret's life and career stand as a testament to a powerful and enduring truth, that in the long run the market rewards not the most aggressive nor the most brilliant, but the most patient and the most disciplined. His story is a masterclass in the art of investment survival. It poses a profound question that we will seek to answer in this deep dive. What are the fundamental, timeless principles that allowed one man's philosophy to navigate 7 decades of unprecedented economic turmoil and to remain as relevant and as powerful in the age of computers as it was in the age of the ticker tape? To study Philip Carret is to study the very bedrock of intelligent long-term investing. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. Philip Carret's journey to becoming the dean of value investing began far from the trading floors of Wall Street. After graduating from Harvard University, he served as a pilot in the United States Army Air Service during the final stages of World War I. Flying the primitive, fragile biplanes of that era was an exercise in constant, high-stakes risk assessment. It was an environment that demanded absolute discipline, a cool head under extreme pressure, and a deep, intuitive understanding of the relationship between your machine's capabilities and the unforgiving laws of physics. It was a brutal but effective training ground for the temperament of a prudent investor, teaching him lessons about risk and survival that he would carry with him for the rest of his life. After the war, he found his way into the world of finance not as a speculator, but as a journalist. He took a job at Barron's magazine, where his role was to analyze companies and report on the financial news of the day. This experience was his true postgraduate education. It forced him to dissect thousands of financial statements, to interview countless corporate executives, and to see firsthand the vast and often comical gap between a company's promotional story and its underlying financial reality. He witnessed the manipulative stock pools of the 1920s and the rampant, uninformed speculation of the public. This period forged in him a deep and abiding skepticism of market hype and a profound respect for cold, hard, verifiable facts. The investment landscape of the Roaring Twenties was a wild and dangerous place. The public, convinced that they were in a new era of permanent prosperity, plunged into the market, often with massive amounts of borrowed money. The dominant investment vehicles of the day were investment trusts, the precursors to modern mutual funds. However, many of these trusts were opaque, highly leveraged, and designed primarily to enrich their founders through complex fee structures. They were instruments of speculation, not of investment. Carret saw a different path. He envisioned a new type of fund, one built not on the shifting sands of market sentiment, but on the solid rock of business value. His idea was revolutionary in its simplicity and its integrity. He would create a mutual fund, a vehicle that would allow the common investor to pool their capital and benefit from professional management and diversification. But unlike the speculative trusts of the day, his fund would have a clear, transparent, and disciplined investment philosophy. It would not engage in short-term trading or speculation. It would be a long-term owner of good businesses, purchased at reasonable prices. In 1928, with an initial investment of $25,000, he launched the Pioneer Fund. He had created one of the very first mutual funds in American history, and he had done so at the absolute peak of the greatest speculative bubble the world had ever seen, just 1 year before the great crash of 1929. His philosophy was about to face the ultimate trial by fire. The crash of 1929 and the ensuing Great Depression was an economic apocalypse. It was a financial cataclysm that wiped out not just the fortunes of speculators, but the life savings of entire generations. The Dow Jones Industrial Average lost nearly 90% of its value from its 1929 peak to its 1932 bottom. Thousands of banks and investment trusts built on the fatal foundations of leverage and speculation were completely annihilated. In this environment of total and systemic collapse, the Pioneer Fund should have been just another casualty. Instead, it survived. And in its survival lies the first great and powerful lesson from Philip Carret. How did he do it? While others were chasing the high-flying speculative stocks of the day, Carret had been quietly and methodically building a portfolio based on a set of principles that seemed quaint in the 1920s but proved to be revolutionary in the 1930s. First, he had an absolute aversion to debt. He focused on investing in companies that had strong balance sheets and little to no leverage. When the economy collapsed and credit markets froze, these were the only companies that could withstand the storm. While their indebted competitors went bankrupt, Carret's companies had the financial fortitude to endure. Second, he placed a supreme importance on honest and capable management. He was not just buying a collection of assets. He was partnering with people. He sought out managers who were conservative, shareholder-friendly, and who understood their business from the ground up. During the Great Depression, these were the leaders who made the tough, intelligent, and ethical decisions necessary to keep their businesses afloat. Third, he focused on tangible assets and intrinsic value. He was not interested in speculative concepts or companies with unproven technologies. He invested in businesses with real factories, real products, and a proven history of generating cash. This defensive and disciplined approach ensured the Pioneer Fund's survival. But Carret's true genius was revealed not just in his defense, but in his offense. As the market plunged to its ultimate bottom in 1932 and 1933, an environment of almost total despair, when the very idea of capitalism seemed to be in question and stocks were being sold for pennies on the dollar, Philip Carret was a buyer. While others were paralyzed by fear, he saw the opportunity of a lifetime. With the cool, detached logic of a pilot assessing a calculated risk, he used his fund's capital to purchase shares in great American businesses at prices that were far below their intrinsic long-term value. He was not catching a falling knife. He was acting on his conviction, buying when the entire world was selling. The Great Depression was not a disaster that disproved Carret's philosophy. It was the brutal, fiery crucible that proved its absolute and enduring truth. It was the ultimate validation that a disciplined, long-term focus on value, quality, and prudent management was not just a profitable strategy in good times, but a survival strategy in the worst of times. The lessons he learned in the depths of the 1930s would become the unshakable foundation for the next 60 years of his legendary career. Having forged his core principles in the unforgiving fire of the Great Depression, Philip Carret spent the next several decades not just applying his philosophy, but refining and articulating it. The post-World War II era ushered in a period of unprecedented economic expansion in the United States, a golden age of prosperity and growth. For an investor like Carret, this was not a time for reckless speculation, but for the patient and disciplined application of his hard-won rules. It was during this long period of steady compounding that he codified his life's wisdom into a famous list of 12 core tenets for successful investing, a framework he humorously referred to as a baker's dozen. These rules are not a rigid, mechanical algorithm for beating the market. They are a profound and flexible framework for thinking like a business owner, a guide to cultivating the temperament and the analytical rigor required for long-term success. To understand the genius of his method, we will not simply list these rules. We will explore them as 4 interconnected pillars that support the entire structure of his investment philosophy. Pillar 1. The business and its management. The first and most important pillar of Carret's philosophy was his unwavering focus on the quality of the underlying business and, above all, the people running it. His foundational rule was to never invest in a business you cannot understand. This principle, later popularized by his admirer Warren Buffett as the circle of competence, was a core tenet for Carret. He believed that the single greatest source of investment error was venturing into industries and companies whose operations, competitive advantages, and revenue models were not crystal clear to the investor. This rule was a powerful defense against the siren song of fads, manias, and speculative story stocks that lacked a solid, comprehensible business foundation. If he could not explain how a company made money in a simple sentence, he would not invest in it. This led directly to his second rule. Buy a business, not a stock certificate. Carret taught that a stock certificate is merely a piece of paper, its price subject to the irrational, manic-depressive whims of what his contemporary Benjamin Graham called Mr. Market. A business, on the other hand, is a living entity with real assets, real products, and real cash flows. The goal of the intelligent investor is to become a silent partner in an excellent business, not to be a fleeting owner of a fluctuating stock. Quote, "This requires a complete shift in mindset, from that of a short-term trader to that of a long-term business owner, focusing on a company's durable competitive advantages, its return on capital, and its long-term prospects for growth." But for Carret, the single most critical component of any business was the quality of its leadership. His most emphatic rule was, above all, invest in honest and able management. He believed that a mediocre business with brilliant management was a better investment than a brilliant business with mediocre management. He argued that over the long run, the integrity, intelligence, and capital allocation skills of a company's executives were the ultimate determinants of its success. He would spend more time investigating the character and track record of a company's CEO than he would analyzing its recent earnings. He looked for leaders who were candid with their shareholders, who were passionate about their business, and who thought like owners, not like employees trying to maximize their next bonus. For Carret, a great management team was the ultimate margin of safety. Pillar 2. The price and the margin of safety. The second pillar of Carret's framework was a disciplined and contrarian approach to valuation. Finding a great business was only half the battle. Buying it at the right price was equally critical. His core rule here was to never pay more for a stock than its justified value. Like Graham, Carret was a staunch believer in the concept of intrinsic value, the underlying objective worth of a business, independent of its fluctuating stock price. The goal was to calculate this value and then demand a significant discount, a margin of safety, before investing. This discount was the investor's protection against errors in judgment, unforeseen negative events, and the inherent uncertainty of the future. To find these discounts, he followed another key rule. Look for businesses that are temporarily out of favor. Carret was a natural contrarian. He understood that the best prices are found not in the glare of popularity, but in the shadows of neglect and pessimism. He instinctively searched for solid, profitable companies that were being ignored or unfairly punished by the market due to a temporary problem, an unpopular industry, or a general market downturn. He knew that the market is a pendulum that swings from irrational optimism to unjustified pessimism. His strategy was to act at the point of maximum pessimism, buying the sound assets that the fearful and short-sighted were discarding. Pillar 3. The long-term mindset. The third pillar is what truly separated Carret from the vast majority of market participants, his profound and almost unimaginable sense of patience. His most famous advice in this regard was to have patience. Never check stock prices on a daily or even weekly basis. He viewed the constant stream of stock quotes as a dangerous distraction, a source of emotional noise designed to provoke short-term irrational decisions. He was not interested in the stock's performance over hours or days. He was interested in the business's performance over years and decades. By deliberately ignoring the market's daily fluctuations, he was able to maintain his focus on what truly mattered, the long-term operational success of the companies he owned. This naturally led to his rule to not try to time the market. He considered the attempt to predict short-term market tops and bottoms to be a fool's errand, a guaranteed path to mediocre returns and costly mistakes. His philosophy was not to jump in and out of the market, but to be fully invested in a portfolio of excellent, fairly priced businesses at all times, trusting their long-term compounding power to overcome any short-term market volatility. This philosophy culminated in his practice of holding stocks for incredibly long periods. One of his rules was to hold on to a stock as long as the company remains sound and there are no fundamental changes for the worse. He was the ultimate long-term partner. One of his most famous investments was in a small soap company called Neutrogena. He bought the stock early in its life and held it for several decades, watching it compound into a massive position before it was eventually acquired by Johnson & Johnson. This was the magic of compounding in action, a force that is only available to those with the patience and the conviction to let it work. Pillar 4. The structure of the portfolio. The final pillar of Carret's philosophy concerned the practical rules of constructing and managing a portfolio. Here his advice was once again contrarian. He warned investors, do not over-diversify. While conventional wisdom preached owning dozens or even hundreds of stocks, Carret believed this was a die-worse-ification that led to average returns. He argued that if you have done the difficult, intensive work of identifying a handful of truly exceptional businesses run by brilliant managers, it is a great mistake to dilute their potential impact by owning a vast collection of mediocre ones. He advocated for a reasonably concentrated portfolio of one's best ideas. However, he was not a proponent of blind buy and hold. His rule was to periodically review your holdings. This is the concept of buy and check. At least once a year, he would re-examine every company in his portfolio to ensure that the original reasons for his investment were still intact. Was the management still excellent? Was the company's competitive advantage still strong? If the fundamental facts had changed for the worse, he would not hesitate to sell no matter how long he had held the stock. Finally, he held one rule that was seared into his soul by the fires of the 1929 crash. Never invest using debt or margin. He understood that leverage is a double-edged sword that, while amplifying gains, also amplifies losses and, most critically, takes away your staying power. A temporary 10-point decline in a stock is a minor event for a cash investor. For a heavily margined investor, it can be a catastrophic wipeout, forcing a liquidation at the worst possible moment. For Carret, solvency was sacrosanct. This complete, cohesive philosophy was the armor that protected the Pioneer Fund, not only during the Great Depression, but also through the later crises of the Golden Age. During the Nifty 50 bubble of the late 1960s and early 1970s, when Wall Street became infatuated with a group of one-decision growth stocks that were considered so good they could be bought at any price, Carret's strict valuation discipline kept him away. While others were paying 50 or 80 times earnings for these popular stocks, he stood aside, and his fund's performance temporarily lagged. But he was vindicated when that bubble burst in the 1973 to 74 crash, and the Nifty 50 stocks lost 70 to 90% of their value, while his portfolio of reasonably priced sound businesses remained resilient. Similarly, during the difficult stagflationary environment of the 1970s, his focus on companies with low debt and strong pricing power allowed him to navigate a lost decade for the broader market with skill and success. His rules had been tested by every conceivable market environment, and they had proven to be unbreakable. As Philip Carret entered the final decades of his extraordinary career, his status evolved from that of a successful fund manager to that of a living legend, a sage of Wall Street whose wisdom was sought by the most serious students of investing. His philosophy, forged in the fires of the Great Depression and proven over half a century of consistent performance, had earned him the ultimate endorsement from the man who would become the most celebrated investor of the modern era, Warren Buffett. Buffett, a man who built his own empire on the very same principles of value, temperament, and a long-term business owner mindset, repeatedly and publicly cited Philip Carret as one of his heroes. He praised Carret for having what he considered the best long-term investment record in American history. For Buffett, Carret was not just a successful stock picker. He was a model of the ideal investor, a man who combined a sharp intellect with an even sharper understanding of human nature, and who conducted his entire career with the highest degree of integrity. This admiration was not a casual comment. It was a profound recognition from one master to another. Carret had been successfully practicing Buffett-style investing for decades before Buffett himself became a household name. He was a true pioneer who had not only developed the right philosophy, but had demonstrated the discipline and the character to adhere to it for a lifetime. This endorsement from the Oracle of Omaha cemented Carret's legacy as the undisputed Dean of Value Investing. The final dramatic test of his philosophy and the ultimate demonstration of his legendary temperament came on October 19, 1987. On that day, known as Black Monday, the Dow Jones Industrial Average collapsed by 508 points, a staggering 22.6% loss in a single session. It was a more violent and terrifying single-day decline than any day during the 1929 crash. The world was gripped by panic. The nascent financial news networks broadcast images of shell-shocked traders on the floor of the exchange, and fears of a new Great Depression were rampant. For a new generation of investors, it felt like the end of the world. But for 91-year-old Philip Carret, it was just another day at the office. He had seen this movie before. In interviews given during the panic, he was a picture of perfect calm and rational detachment. He viewed the crash not as an apocalypse, but as a classic, if extreme, example of market panic, a violent, emotional overreaction that had little to do with the underlying value of the businesses he owned. While others were frantically selling, he saw the crash for what it was, a fire sale. It was a rare and wonderful opportunity to purchase shares in excellent American companies at deeply discounted prices. This was not bravery in the conventional sense. It was the product of a lifetime of experience. A man who had had the courage to buy stocks in the abyssal depths of 1932 was not going to be frightened by a one-day panic in 1987. His reaction was the ultimate testament to the power of a long-term historical perspective. It proved that in investing, temperament is not just important, it is everything. In his later years, as he reflected on his 7 decades in the market, Carret distilled his philosophy into a few simple, powerful truths. He believed above all in the importance of temperament. He argued that the essential qualities for an investor were not a genius-level intellect or a PhD in finance, but patience, humility, and to control one's emotions. The market, he taught, is a machine for transferring wealth from the impatient to the patient. He was a great believer in common sense. He was deeply skeptical of overly complex financial models and the jargon-filled pronouncements of Wall Street experts. He believed that good investing was not complicated. It was based on simple, sound business logic. Find a good company run by honest people. Do not pay too much for it, and hold it for a very long time. He also embodied the principle of lifelong learning. Even in his 90s, he was a voracious reader, constantly curious about new industries, new technologies, and new ideas. He knew that the world was constantly changing, and that an investor must always remain a student. And finally, he maintained a crucial sense of humor and detachment, which prevented him from ever taking the market's daily melodrama too seriously. But the ultimate proof of his philosophy is not in his words, but in the numbers. The Pioneer Fund, which he founded with $25,000 in 1928, went on to become a multi-billion-dollar institution. For the 55 years that he personally managed it, from 1928 to 1983, it generated an average annual return of approximately 13%. This may not sound as spectacular as the returns of a high-flying speculator, but its power lies in its consistency and longevity. An investment of $10,000 in the Pioneer Fund at its inception would have grown into more than $8 million by the time he retired, a staggering testament to the quiet, inexorable magic of long-term compounding. His 70-year track record is the final, irrefutable proof of his life's work. The legacy of Philip Carret is a powerful and enduring testament to the idea that in the world of investing, the race is not won by the swift but by the steady. His 70-year career on Wall Street is perhaps the most powerful argument ever made for a simple, robust, and value-driven philosophy. He was not a market timer, not a speculator, not a chaser of fads. He was a partner in businesses, a steward of capital, and a master of the one variable that is most critical and most difficult to control: human temperament. He proved, through a lifetime of disciplined practice, that success in investing is a marathon, not a sprint, and that the greatest returns belong not to the most brilliant, but to the most patient. The world of financial markets is vast, and there is no single path to mastery. Today we have dissected the long-term, value-driven approach of Philip Carret. But do not forget the other great schools of thought: the art of speculation and tape reading from Jesse Livermore, the analysis of market structure and the actions of smart money from Richard Wyckoff, and the deep understanding of time cycles from William Delbert Gann. Each of them offers a unique and powerful perspective on the market. All links to the channels for their in-depth study can be found in the description of this video.